If you listen to most finance influencers, they will show you an elaborate spreadsheet and tell you that investing in U.S. equities is a birthright. Put your money in the S&P 500, an index tracking the 500 largest publicly traded companies in the U.S., and you will supposedly lock in a safe 10 to 15% return every single year until you retire. But that straight-line path to wealth is not a natural law of economics. For the last 90 years, that growth has been the result of a highly specific, carefully engineered financial ecosystem controlled entirely by the United States. Here is how that machine actually works. The U.S. holds the right to print the global reserve currency. It uses those dollars to import cheap goods from manufacturing hubs like China. But instead of holding on to that cash, those foreign nations are heavily incentivized to loan that exact same money right back to the U.S. by purchasing government treasury bonds. This chart shows the historical S&P 500, fueled entirely by that massive closed-loop system. Because the U.S. provides a lucrative, high-spending consumer base and enforces the institutional rules of global trade, foreign capital continually floods back into the American domestic market, pushing this line steadily upward. Relying on a 30-year passive investing spreadsheet assumes this unipolar American setup will run unchallenged forever. Today, that assumption is a mathematical risk for your portfolio. We are currently watching the United States and China strategically decouple. The unified, frictionless era of global trade that powered your passive index funds is being dismantled piece by piece. We see this playing out physically through aggressive new tariffs and protectionist laws. The U.S. is actively weaponizing its thriving domestic consumer market, threatening trading partners with heavy financial penalties if they try to sell their goods to American citizens without paying a steep toll. We have officially entered a wartime economy. Global superpowers are no longer optimizing for the cheapest, most efficient global supply chains. They are prioritizing localized security, bringing critical manufacturing back inside their own borders to insulate themselves from international shocks. If you ignore this shift and leave your money parked in the old system, you risk following the trajectory of the Japanese markets in the 90s, where indices stagnated for decades. Without adjusting to this new landscape, your long-term retirement goals are effectively unreachable. To understand how the U.S. handles economic threats, we have to look back to the 1970s and 80s. Japan's manufacturing sector had become a relentless force, operating at a scale that legitimately challenged American economic dominance. By the 1980s, Japan had moved beyond basic manufacturing. They were dominating advanced consumer electronics and mastering the assembly of complex, high-value goods that directly threatened American technological superiority. By 1985, the U.S. decided to put an end to it. They forced the signing of the Plaza Accord. The Plaza Accord was a coordinated geopolitical agreement between 5 major nations designed specifically to manipulate global currency exchange rates. The mechanics of the accord were brutal and highly effective. The U.S. and its allies actively intervened in the foreign exchange markets to devalue the American dollar. In turn, this forced Japan to drastically increase the value of the yen. Almost overnight, Japanese electronics and vehicles became incredibly expensive for the rest of the world to buy. This graph charts the resulting devastation, an era known as Japan's lost decades. With their critical export market suddenly choked off, Japan's central bank slashed interest rates in a panic. That desperate manipulation inflated a massive domestic asset bubble that eventually popped, sending their economic growth into a 30-year freefall. The United States successfully neutralized its single biggest economic rival without firing a single bullet. They proved that international trade agreements and targeted currency manipulation are the ultimate weapons of modern financial warfare. Fast forward to today. The U.S. is facing a nearly identical threat from China's manufacturing might, and they are attempting to run that exact same 1980s containment playbook. But there is a crucial difference. The Chinese state closely studied Japan's catastrophic collapse. They realized that depending entirely on free markets and foreign exports was a severe vulnerability. To counter it, they rebuilt their entire economy to absorb a direct American financial assault. Instead of relying on vulnerable free markets, China operates on a public-private partnership model, a system where the government maintains absolute, unquestioned authority over private enterprise. High-profile tech billionaires are allowed to generate wealth, but the moment they step out of line, the state steps in to subordinate them to national interests. Through that strict control, China successfully constructed a massive, highly localized technology and manufacturing base. They now have a thriving, closed-loop domestic market that operates entirely independently from American consumers. Because China controls its own vast internal demand and tightly regulates its private sector, the old Plaza Accord strategy of currency manipulation will fail. We are no longer living in a US-dominated monopoly. We are locked into a permanently divided, bipolar global economy. In this new Cold War, both empires have distinct advantages. America is geographically blessed with non-hostile borders, and more importantly, it has secured absolute domestic dominance over its own energy and oil supplies. China holds a completely different trump card. They control a near monopoly on rare earth metals, a group of 17 chemically similar elements that are the non-negotiable raw materials required to manufacture electric vehicles, space exploration technology, and advanced military hardware. When these two superpowers inevitably clash over those critical resources, it triggers secondary proxy conflicts. If China restricts rare earth metals, the US can retaliate by cutting off shipping lanes that deliver crucial foreign oil supplies to Chinese ports. As the US withdraws its global security blanket to focus on this localized conflict, the rest of the world becomes collateral damage. Import-dependent emerging markets caught in the crossfire are already seeing severe capital flight and aggressive currency devaluation. This brings us to the core strategy for your portfolio. In this new environment, you must account for political instability as a constant factor. Geopolitical shocks will drive market prices more frequently than corporate earnings, making active trading a necessity. The ultimate prize in this two-empire showdown is artificial intelligence. The infrastructure and computing stack required to build AI will dictate the next wave of global productivity. The nation that wins this technological race will secure a dominant economic lead for the next 20 years. To survive, you need a defensive barbell strategy. On one end, you aggressively build an AI-first portfolio to capture the immense technological upside. On the other end, you tactically hedge your bets by acquiring physical assets, like gold, specifically buying in during brief market dips. The long era of blind, guaranteed passive growth is officially dead. Your retirement spreadsheet from 10 years ago will not save you. True financial survival now requires treating every dollar of your capital as a highly tactical asset in an ongoing global war.